Hello and welcome to Fidelity Connect. I'm Glenn Davidson. In today's volatile market, staying nimble is key, and investing in a portfolio that can manage risk while offering global exposure could be your ticket to paradise. How are our next guests leveraging their strategies to successfully navigate today's market environment, and which market sectors are they closely monitoring? Joining me today to discuss opportunities in global small caps for the months ahead are portfolio managers Gordon and Chris Maludzinski. And together they manage Fidelity Global Small Cap Opportunities Fund. Connor, wonderful to have you here. And Chris, good to see you there as well.
Thanks, Glenn.
I would be remiss if I didn't start this webcast asking about your thoughts on tariffs. You're not a macro guy, neither are you, Chris. And that's not what this fund is about, but there's so much drama going on. It's important for us as viewers and for you as portfolio managers to discuss. So could you kick us off?
Yeah, absolutely. Look, I mean, it's obviously topical, but during volatile times, during this, today, it's helpful to remember that sometimes the market panics, and the key for us as investors is to not panic, right? And if you just look at let's just take the last 5, 6, 7 years, 2018, right? Every year or two, the market's going to do something crazy. And if you look at 2018, it was the first bout of tariffs, right? The first Chinese tariffs when Trump was there. 2020, we had COVID. 2022 was Russia, Ukraine, inflation, right? First time we've seen inflation in decades. 2023, regional bank meltdown. 2024, yen carry trade unwind, right? Every year something crazy happens. The point is, don't panic. We've seen volatility before. We've gotten through it. We are going to get through it again. And I think during times like these, what Chris and I are trying to do is really have two priorities. One, make sure that we have a resilient portfolio before events start to happen. And two, really try to take advantage of the opportunity set when it changes. So I think on the first point, what have we been doing for the past couple of months? This is not, we can't be reacting today. We have to have been doing the work prior to this. Is really, scraping through the portfolio and knowing where we are exposed. We have stocks, they're down today. We knew that they were going to be down today if this, tariff risk transpired. But, we own them because we like the 2 or 3 year story, right? For example. So the whole point is build that portfolio that is resilient and continues to move forward, kind of accepting that you're going to have a couple stocks here and there that are going to get hit. But the more important thing, you've heard me say this a million times, volatility creates dislocation. Dislocation creates mispricing. So we are really, really focused on what does the opportunity set look like now? How is that changing? And as you know, we are a global fund, and one of the flexibility that gives us, particularly today, the ability to go across geography. That we're not constrained to be in the United States or in Canada. We can go to Europe. We can go to Japan. We can go, if we want to emerging markets. And I'm sure we'll talk about this, but this is one of the tilts that we have been moving toward, more markets outside of the United States. And I think that is a trade that we've been expressing, and I think we'll continue to express that we can get into.
You're cool, calm, and collected on a day like this. Chris, over to you.
No, I just wanted to flesh out a couple things that Connor mentioned kind of off the top there. So I guess what does it mean, if you have tariff exposed businesses? I mean, high margins, strong balance sheet, and pricing power. I mean, that's kind of the way you want to be positioned. So you don't want to have a company with a weak balance sheet, no pricing power, and low margins because, if they do get hit by elevated tariffs, they may be out of business. So we want to make sure that we're positioned in those companies that are going to steal market share, the industry leaders that are going to get stronger with any potential, disruption. So, as Connor mentioned, the global opportunity set that we have, I think a lot of our time over the past 3 to 6 months has been spent in, more defensive areas. So you can think, healthcare, real estate, areas like that. And a lot of those, consumer staples. And if you look at a lot of those valuations over the last 3 to 6 months, a lot of them have, re-rated 20 to 30%, and with very little earnings revision, so positive earnings revision. So it's all been multiple expansion, right? It's a very defensive market, and a lot of these companies obviously have led year to date, but that's not a very exciting, kind of risk reward proposition over the next, 2 to 3 years when you're buying these stocks at elevated multiples. The IRRs are really quite skinny. So, Connor mentioned it, volatility creates mispricing, mispricing creates opportunities. So, spending obviously a lot more time, especially today on these kind of tariff exposed businesses and seeing if we can add, more risk to the portfolio because, when you have stocks making 15 to 30%, moves down in a single day, that could be interesting. Not saying that all these, companies have been oversold, but generally the baby gets thrown out with the bathwater.
Really interesting comments, Chris. And Connor, you mentioned about the opportunity to go global, which is a wonderful position for the two of you to be in. Investors have really paid a lot for $1 of earnings in the United States, haven't they? And you've already been preparing them. As you said, you've already developed a portfolio that anticipates a bit of what we are experiencing now. But how do you utilize the resources globally to give you those ideas?
Yeah, I think this is one of the benefits where, even last night, right? On the phone with multiple analysts on our team, and we have research teams in Toronto, we have research teams in London, Tokyo, Singapore, Sydney, right? We have people on the ground that are doing the work, and hopefully can surface those investment ideas to Chris and I, right? And I think the more you broaden your opportunity set, the more degrees of freedom that you give yourself. Hopefully, that is going to give you the opportunity to find some give you the opportunity set with the ability to outperform. That isn't necessarily 100% correlated with what's going on in the United States, for example. And just having that flexibility by geography, by sector, by industry, hopefully you can take advantage of positive change and temporary dislocation that is so core to what we do.
Chris, how do you manage that without being awake 24/7?
Yeah, well, funny enough, I got an example that'll bring that to light, the power of the Fidelity platform and why it's so special. So there was an Australian company that bought a US company, a cash share deal last week. We have an analyst in Toronto that covers the US based company, and an analyst in Australia that covers the Australian company. And so, we were able to sit down at 9 p.m. Eastern time and have a real time conversation, the week of the deal, and really form a view on, hey, what are the cost synergies? What are the revenue synergies? Are they going to be able to execute? The stock was sold off in Australia because there were some questions on whether the combination was good. And, we were able to form a view on that well before, any of the, sell side analysts had gotten up to speed. So just having that global platform and the ability to, do the deep research before, our competitors or even the sell side can is obviously a huge advantage.
Connor, you talked about utilizing resources, other portfolio managers being able to pick up a phone, look on a computer, and just get so much information. Does Fidelity also have government liaisons that you discuss things with, or is there a bit of a task force behind the scenes discussing what's going on governmentally?
I think, that's just one element. I think, we're obviously very focused, or our analysts are very focused on bottom-up research. But one of the things that you're trying to do as a portfolio manager is create that mosaic, right? We don't necessarily 100% focus on macro, but you have to be aware of, okay, particularly in a global fund, central bank policies by geography, right? What are government policies fiscal policies? And I think, to be honest, that is a point that we've been really focused on more recently, right? And I think I mentioned it, but one of the shifts that we've been making in the portfolio is actually tilting more toward Europe, and that is a direct response to the fiscal situation that is developing in Europe. And I think for the first time, in my investment career, I can truthfully look at you and say, the outlook for Europe, I think at this point, is starting to look potentially better than the United States. And that is not something that we have had since we've been managing this fund, right, since 2019. And you kind of sit back and say, why? Well, there was an election in Germany in February 23rd, I believe. And, effectively what you had is you've now had this coalition that has come in and passed a fiscal spending bill that is going to, result in a lot of fiscal stimulus, right? And the Germans had to change their constitution in order to do so. So effectively, what you have is a new government that has come in, and I'll spare you the gore details, but effectively, a $500 billion infrastructure fund over 10 years, so call it $50 billion a year. Now, keep in mind, Germany is like I think $4.7 trillion GDP country. So this is like over 1% of GDP on spending per year. And they changed what is known as the debt brake. So Germany constitutionally has not been able to run a fiscal deficit greater than 0.35% of GDP. Now, compare that with the exceptional United States, which has been running at 6 or 7% of GDP. Now, that's not exceptional, right? It's been exceptional because the government has been spending a lot of money. So what you have is this period now where we think you are going to have a period where quote unquote the United States is going to go through a period of detox, meaning lower spending, and you can see tariffs are one element of this administration's strategy to enforce that. And on the other side, you're going to have basically Germany, the heart of Europe, which is an economy that's been in recession for 2 years, spending on infrastructure, effectively giving them an unlimited budget to spend on defense spending, right? Spending on hard assets is going to be very, very stimulative for the economy. And for the first time, we have been spending a lot more time there. We've been spending more time on the secondary impact, right? Not just the called industrials materials complex, but also the financials complex. And ultimately, we think that will eventually feed down into the consumer as well. But kind of like for many people who might be watching, right, this is potentially going to result in a wholesale shift in everyone has been wanting to go into the United States. 70% of or 60-70% of all the market cap is going to the United States, and suddenly you have relative fundamentals moving the other direction. And given, as you can see, the currency moves that we've been seeing today, just currencies moving 2-3% this morning, I think you're starting to see potentially the start of a move in capital flows as well. And if that happens, it's going to be very, very positive for international assets and less positive for U.S.-based assets.
I love how you said detox for the United States. This disruption globally should cause a good retool. It could cause a very good retooling of the way economies do business.
100%.
Couldn't it? Chris, let me ask.
Glenn, maybe I'll just
ahead.
add to that a little bit. I mean, we talk a lot about we're 100% bottoms up focused, and our process is positive inflection points, temporary dislocations. What Connor just spoke about though is obviously on a macro level a positive inflection point with obviously more European fiscal spending. So I guess if you rewind the clock like a year ago, all the talk was, hey, Europe's cheap valuations, a lot of international assets are cheap, but it was generally viewed as lower growth and lower return. So it warranted a discounted multiple. Well, today you kind of have that macro positive inflection point, and you can kind of see a scenario where positive earnings revisions kind of develop over the next few years, which is the catalyst obviously for a re-rating, especially vis-a-vis the US market. So that's why when you look at a lot of companies that they're 15, 20, 25% discounts to kind of what you find in North America, it's a lot more attractive today with that fiscal backdrop than it was a year ago.
Sounds like shopping overseas is much more fun. Chris, while you have the mic, let me ask you, could you just define global small cap opportunities for our viewers so that we're reminded of the structure and what the prospectus allows you to do?
Sure. Yeah, it's a very flexible mandate. It's a global go anywhere best ideas fund. So, it's built 100% bottoms up. So we're able to, utilize, Connor's best ideas, my best ideas, or 140 analysts across the globe, their best ideas, and, really construct a bottom up portfolio with obviously the most attractive risk reward attributes and a very high prospective IRR. That's the goal of the fund. So it's built 100% bottom up, but we're obviously attracted to where the dislocation, where the opportunities are, and that's kind of how we shift our time.
As economies transition to a more independent structure potentially, does that benefit small and mid-cap companies?
So part of this has to do with this. So if you just think about that, what are we potentially going to spend? It's going to result in CapEx cycle, right? And typically, a CapEx cycle is very, very positive for industrials, materials, energy, financials. Now, energy is kind of a separate point at this point, but think about industrials, materials, and financials. And this is not going to be the same analog, but if you just rewind the clock to the early 2000s, when you had China entering the world economy, there was an absolutely enormous infrastructure build out, right? I can't remember the statistics, but the amount of cement that China produced and consumed in a decade was equivalent to the entire consumption of the United States the past century, right? It was just this absolutely enormous build out. Now, we're not suggesting this is going to be the same scale, But when you start thinking about what does that mean for investment in hard assets and infrastructure, small cap companies tend to be more skewed to those sectors, right? Where they're not skewed is where everyone else is currently positioned, technology, right? And so again, just we've been talking about relative shifts in geography. This is also potentially moving into potentially relative shift in sectors, right? And historically, Chris and I have had, I think we've had less than 5% exposure to technology stocks. And historically, our focus and our expertise lies in industrials, consumer, and financials. So I think we are particularly well placed if the kind of the themes and the trends that we're talking about begin to happen. I think we are particularly well placed to take advantage of them.
Mentioning the early 2000s makes me also think of the late 90s and the focus on telecom, technology, and healthcare. And the funds that weren't so dominant in those areas tended to weather the storm very well. Chris, let me ask you about how the two of you divide up your areas of specialization.
Sure. So we're actually able to go in any geography in any sector, between Connor and I. So, if Connor finds a good idea in the consumer sector, he's able to put it into the funds. We wanted to keep this obviously very flexible and make sure that the IRR is always optimized, right? We always want to put those best ideas into the fund. But if you think about Connor and in my experience, I guess over the last 15 years, I spent a lot of time, in consumer and financials, in resources. Connor spent the first, 5 years of his analyst career doing kind of everything else. So IT, healthcare, industrials, and then became kind of a global kind of small cap generalist analyst. So I think the key point here is that, we're able to play devil's advocate, with our, past experiences, but we're able to go in any geography, in any sector. So we're not constrained in that sense.
The latest portfolio allocation will be published, I think, later this week. So I can only go on what we've seen as of the end of December. But Canada made itself into the portfolio to the tune of, if I recall correctly, around 13 or 14%. Chris, can you comment on your Canadian allocation?
Sure. So if you think about Canada, it's not domestic Canada. So we're not buying, companies that source and sell in Canada. They're generally more global exposed. So, Fairfax is in our top 10 as of the last disclosure. They're a global property casualty insurance and reinsurance company, happen to be headquartered in Canada. But again, you got that kind of global exposure and diversification. So you kind of run down the list. I mean, RB Global, they're a salvage auction operator in the US and sell heavy equipment, used heavy equipment. They're an auction operator there and primarily in the US as well. Happen to be headquartered in Canada and count for Canadian content. But if you think about those two businesses, they're really global in nature, with a North American kind of stronghold.
Great. And Connor, you mentioned China a couple of minutes ago. Exposure, is that something that the fund is allocated towards? And do you see that increasing, decreasing?
So historically, China, obviously big part of the emerging market index or exposure. Historically, we have not had, any exposure to China. And very de minimis exposure to emerging markets in general. And our view generally is that we're very, the farther we go from home, the more, the farther you go from home, the more language barriers there are, the more barriers to financial transparency that you have, the more risk there is. And Chris and I are really kind of in the business of trying to minimize risk. So we want, if we were to ever do that, we would have to need a return hurdle that was, call it exceedingly high. Mm-hmm. But the way we get exposure to, historically at least, we've had exposure to China, is you can buy some wonderful companies that are in Japan, right? So developed market that typically has significantly higher IP content, particularly within the industrial sphere, where you're selling into a lot of Chinese companies. So these are not companies we've invested in, but you can think of Chinese or Japanese companies like Keyence or Fanuc, some of the factory automation companies that have absolutely incredible global franchises, where a lot of the sales are actually going into China, right? So that would be in a way that we would tend to get exposure
by a Japanese company. It's like a derivative of. So
exactly. So you can be a little bit confident that, or a little bit more confident that the business models are a little bit higher quality. You can be a little bit more confident in the management quality of the business, and ultimately, the rule of law and your shareholding. So that would be the way that we would tend to typically get exposure to China.
What about on the U.S. market? Would you buy an ADR of a Chinese company?
Everything is situation specific.
I see. Chris, well, what happens if a small cap name turns into a mid or a large cap name? Are we going to have to rename this the Global Mid Cap Opportunities Fund? What's
never say never, but the good thing is we don't have a sunset clause, so we're kind of in the business of trying to find tomorrow's mid and large cap companies, and to do so, it'd be a shame if we found one, and just as its growth started to take off and the market started to appreciate it, then we'd have to sell it and recycle that company into another quote unquote kind of small cap. So the way we define small cap is between $1 and $14 billion, and then 30% can be above that $14 billion range, to really just let our winners continue to run. So we have a number of examples in the fund today that were small caps yesterday, and I guess today you can consider them mid caps, but the thesis is still intact. We still really like the fundamentals, the management team, they're executing, and it would just be a shame to sell them when the market really just starts to appreciate them.
That's great news. Private companies, is that an allocation within the portfolio?
We historically haven't had any private company exposure, and I think part of it, I think, if you think about private companies, most of them have been focused in the technology sphere, sure, where or in healthcare and biotech, and as we've talked, that is typically an area of the market, or that Chris and I historically have not focused on. And if you just go back, Chris kind of mentioned this off the top, but one of our big filter tends to be, from our quality filter, we think quality is three things, which is profitability, predictability, and growth. And so from a profitability perspective, we're looking for companies that generate high return on capital and positive free cash flow. And then, secondarily, predictability. So we want to be able to look out 3 years at least and have pretty good confidence in what the earnings power of the business is. If we can't predict the earnings, our view is we can't value the stock. And if we can't value stock, we're not going to buy that stock. So those two first conditions really rule out a lot of the, let's call it investable universe inside of the technology and healthcare space. So, it just structurally, from our investment process, is not a place where we go fishing, right? And I think in general, we talked about, Chris kind of mentioned, right, our view of small cap is kind of between $1 and $15 billion, $14, $15 billion at the top end. And, functionally, it tends to be more like $2 billion. And below that, we kind of view that as micro caps, right? And I think what we never want to have happen is we don't want to get stuck in an illiquid position, right? So, if you're private, by definition, you are not traded. And we always want to, have liquidity. And I think it's one of those things, right? When we buy stocks, we're going to get some stocks right. We're going to get some stocks wrong. When we make mistakes, I want to correct that mistake as fast as I possibly can. And so that, in order to do that, I need liquidity.
Chris, let me ask you about artificial intelligence, but not from a tech standpoint, because Connor just put me in my place with that, but more from an infrastructure standpoint. Are there ways you can be looking at small cap companies and deploying capital into small cap companies that benefit from the focus on AI?
Yeah, I mean, I guess this was, a bigger topic when you rewind the clock a couple of years ago and we were having a conversation. It was really about finding those, high quality industrial businesses that were benefiting from the AI kind of CapEx cycle, right? Especially last year, there was a very strong, narrative that the world was short power. The AI growth trend will last, 10, 20 years into the future. Today, that's a little bit made a little bit more uncertain. But I think that the bottom line is that the world still is short power, and we still continue to hold some of those high quality businesses that are benefiting from that infrastructure and kind of power build out led by AI.
Would that be true of digital assets? The U.S. administration seems to favor digital assets, and there's likely ways from an infrastructure standpoint to invest in that space. Is that a fair point?
Yeah, Connor, I don't know if you have any comments on that, but I mean, obviously power, is a derivative of that, right? So, we don't have any, very strong views personally, Glenn, on digital assets and maybe their relevance in the world in 10 years. That's not really what we do. But it just really has accelerated kind of a lot of these companies that we've been invested in for the past 3 years.
Connor, thoughts?
Yeah, I think one of the things, I call it flying near the blue part of the flame, right? And I think with respect to AI or crypto, we tend to want to find as a general statement, tend to want to find the opportunities that are hidden, right? Where we can form a differentiated view on ultimately the long-term earnings power of a business, right? And it's in that an inflection point that allows us to give us a differentiated view. That's where we've been able to source our alpha from historically. So we tend to be focused more on kind of the second or third derivatives that people aren't paying attention to, right? I often like to say, based on the rule of page 16, right? You don't make money based on investing on what's on the front page. You make money based on what's on page 16 that's heading to the front page. So that's where we want to focus our time when these hot topics are all over the newspaper. We don't really want to be looking there.
Page 16, and what's going to make it to page 1? I like that. Chris, we're just going to wrap in a couple of minutes. So some areas of focus that you're excited about, given all that's going on, a couple of areas that you're excited about as we progress through 2025.
Yeah, no, I mean, it's a good question, Glenn, especially on a day like today. So really looking at the volatility that the market's throwing at us today, seeing if there's any opportunities there. And then just more on the interest rate sensitive side of things. I mean, the housing market, especially on the resale side, has been in a bear market for going on 3 years now. And you look at the futures market today, and it looks like the cutting cycle may get accelerated here in the U.S. So beneficiaries of that are obviously interest rate sensitive companies, and you can think housing, new housing, resale housing, and the market's really priced those companies, to bump along the bottom for a number of years into the future. So we may get a positive earnings revision cycle as interest rates start to come down.
Thank you. And Connor, your thoughts on areas you're excited about going into 2025?
Yeah, I think what we've been talking about, right? And I think some of the more international stocks, particularly those, industrial businesses, financial businesses, particularly in Europe, and then trying to, also look at, markets that people aren't really paying that much attention to, namely kind of like, in particular, I think domestic Japanese businesses are starting to look attractive. And again, that wholesale shift, honestly, from where we've been spending most of our time, right? I think 60-70% of our exposure historically has been in the United States, right? And now we're starting to, move the other way. And again, it just comes back to having that flexible opportunity set, right? We are trying to find the best risk reward, regardless of where the company happens to be headquartered in the world. And if we can do that, we can be nimble. He's talked about being nimble off the top during periods of volatility. Hopefully we can take advantage of that and really make some money for our clients.
Well, as we do this webcast, as we speak, the market is not in a good position. Who knows where it goes today? And but from talking to both of you, you're very comfortable with the positioning of global small cap opportunities, and you're comfortable with the opportunity set that you have as well. And for myself and our viewers, it's comforting to hear that. So thank you very much, Chris Maludzinski and Connor Gordon, for being with us today.
Thanks, everyone.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.